Hey, what's up, you investors? This is Lukas here from excelwealth.com. Now, if you're still thinking about investing, good for you. But have you thought about the ways to reduce risk? Because I'll tell you this, risk-free investing doesn't exist. But there are ways to reduce the risk. And today's video, I'm going to show you 5 ways to reduce these risks. Be sure to check out the last one because that's a very interesting one that most likely you haven't thought of before. Let's go into the video. Okay, so as an investor, the thing that we always have to struggle with is risk. Now, the first thing that you could do is invest in stocks and in companies that are not so volatile. Because then, the chance of them going bust or the chance for your stock to fall like hugely is just, a lot less. And it sounds very obvious, but the thing is this, of course, if you reduce this risk of buying a less volatile stock, for example, like if you buy into Amazon or into Tesla, well, Tesla's maybe not a good example, but because, Elon Musk sometimes just tweets something weird stuff and then all of a sudden Tesla just falls again. But, so this is why maybe Tesla is not the best example. But Amazon, Google, those Microsoft, those big companies, hardly any volatility. Volatility meaning going up and down, doesn't go up and down that much, and actually in general just grows over time. Those are the less risky stocks, but yes, the return is also less. The second method to apply to reduce risk is, of course, let time do its thing. Now, when we take a look at those bigger companies, those growth companies, yes, those companies go up and down, so the volatility may be actually bigger. But in the end, a big company, when you just leave it for 10, 50, maybe 20 years, they just grow. That's the only thing. They just grow. Because in the end, they have a good intrinsic value, and that just grows over time. Now, if we do look at Amazon, for example, 20 years ago in 2000, it was just like a tiny, tiny company. Was just worth a couple of $1 million. If you just bought into that company and thought like, what? I know that they're just selling books online, and online just, was a small thing back then. I don't know if the company will do well or not. I don't know. I'm not sure. But since you left it there for 20 years, take a look at it right now. One stock is valued so much more and has been stock split several times. So yes, your stock would have been worth so many more times compared to back then, which was only $2 back then in 2000. So yes, let time do its thing to reduce the risk. Now the third method is to purchase stocks using a certain strategy. Now, you can actually just buy a stock saying like, I'm going to buy a Tesla stock for $1,000 and just wait it out. Yes, that's a way. But you can also spread out your risk by spreading it, by buying it into, for example, like little bites each and every time, which is called the dollar cost averaging. Everybody knows that. And if you don't yet, there are videos on dollar cost averaging. And yes, I've shot them as well, but I can't really find them in my whole playlist. Because otherwise I would say like, click up the pop-up button and then you can go to the video. But I can't find the video. But that's okay. So dollar cost averaging, buying into the stock each and every month, for example. Every time buy a little bit. Because if you spend $600 at one time, or you spend $50 per month every month, and then in 1 year time you spend the same amount. But because you keep on buying at higher and lower moments, hey, that's a way to spread your risk, because then you're not buying into one moment of the market, but it's your time in the market. So it's not trying to time the market, but it's your time in the market. So each time you just take place and join into the investment game. That's the whole idea of spreading your risk. So buying through investments. Now the fourth method of reducing your risk while investing is spreading your investments. Now I'm not saying like the buying strategy. In this case, we're talking about different sectors and variety. Sectors, for example, could be technology or healthcare, and you could also buy in different regions, for example, like North America, but also in Asia, but also in Europe, so different places. Having your stocks in all kinds of places, the moment something happens in one region, you get a new president in the US, for example, doesn't change the whole stocks in Asia or in Europe. Whereas the moment a certain country is being, struck by a certain flood, doesn't change all the stocks in another country. Or when, for example, a pandemic strike, doesn't mean that the technology sector is also struck by the pandemic. Also different ways to reducing your risk. Now the fifth method is the most important method, I would always say, to reduce your investments. And that is to have a very, very, I'm saying very, very often, that very important is to have a selling method. Now this is the biggest thing. So many people know how to select a certain stock. So many people know how to buy a certain stock. So many people know when to buy a certain stock. But the biggest question is, when do you sell? How do you sell? And for what reason do you sell? Let's pretend. If you type in Google right now, when is the best moment to sell your stocks? Google will give you the time somewhere between 20 and 25%. So the moment you make a certain profit, that's the moment you sell, which is very obvious, of course. You won't be selling like, you know what, I'm making a loss here of 10%. Maybe it's a good time to sell, I'm feeling crappy. and now I know that you're laughing about that because people do that. I bought some cryptocurrency and oh no, I'm seeing it fall. Maybe it's a time to sell. Yes, that's an idiot. That's what an idiot does. That's what emotion selling is. This is why you should have a very clear selling strategy. When do you sell? Now, one of my advices I tell my people is sell every time you have 10% profit. Now you might be thinking, yeah, but Lukas, 10% isn't that much. I get that. But you can always try and wait until 25% of profit is reached. What if it's only reached 19%? Would you sell? No, because your strategy said 25%. If I say 10%, every time 10%, well, at least I've sold 10%, maybe once, maybe twice, before you got to your 25%. Yeah, I'm seeing you thinking and calculating right now. I can see you thinking, yeah. Let's just come, okay, you know what? Let's just do it again. You're waiting for your stock to grow up to 25% to be able to sell. Okay? The moment I reach 10%, I sell. I'm safe. That part of the money, that 10% of profit is already safe because I've sold that part. The next time I reach 10%, I sell it again. And no, that's not twice 10% is 20%. That's not the case. So it's not 2 times 20% is 20%. Okay? Because stocks do go up and down all the time. You're still waiting for your stock to grow all the way to 25%. But in the meantime, I might have sold off my stock at 10%, twice, maybe even 3 times already. I've secured that part of the money already, several times. And you're still waiting for your stock to go up to 25%. Still waiting for my stock to go to 25%. I get that. Well, I've sold and secured several times of 10% profit already. And that's how you reduce the risk using a very clear selling strategy. And if you like this video, of course, be sure to hit that like button because it will really help out YouTube's algorithm. And of course, if you like more content like this, be sure to come back to my channel and watch videos like these. I thank you very much for watching. Happy investing. See you on the next.